Let me ask you this. What could a lazy painter and a stock chart possibly have in common? I know, it sounds like the beginning of a bad joke, right? But the answer is actually the key to understanding a massive concept in trading. Let's get into it.
All right, let's unpack that little riddle with our first big idea, the lazy painter analogy. This is really where it's all going to start to click.
Okay, I want you to picture this. You're painting a wall. If you move your paint roller nice and easy, nice and slow, the paint covers everything perfectly, doesn't it? But what happens if you get impatient? You get a little lazy and you just yank that roller up the wall really, really fast. You miss a spot. You leave this empty, ugly little gap in the paint.
Well, believe it or not, financial markets do the exact same thing. When a price moves way too fast, either up or down, it leaves behind one of those missed spots on the chart. In the world of trading, we call this a fair value gap, or FVG for short. Just think of it as a literal gap in pricing that the market often feels this need to go back and repaint.
So how in the world do we actually find these gaps? Well, the great news is you don't need any complicated software. You don't need to be a math genius. All it takes is spotting a really simple clue that's hiding right there in the chart.
That's right, you can put your calculator away for this one. To find one of the market's most powerful signals, all you really need to do is be able to count to 3. It's all about spotting a very specific 3-candle pattern.
Now, inside that 3-candle pattern, one of them almost always just jumps off the screen. It's that huge, explosive candle that shows a sudden, really aggressive move. But what is that thing, and what is it telling us?
Here's another fun way to think about it. Just imagine a giant elephant jumping into a swimming pool. The splash it creates is going to be enormous, right? It's powerful, and it's totally impossible to ignore. Well, that big candle, that's the market's version of that splash. The official term for this kind of splash is displacement. It basically means there was a massive amount of buying or selling pressure that just shoved the price so hard and so fast that it created that sloppy, inefficient gap we were talking about. This splash is the engine that creates the whole thing. Okay, let's walk through this step by step. First, find candle number 1. You see that little thin line at the top? That's called a wick. We care about the very top of that wick. Next, you spot candle 2. That's our big elephant splash, our displacement candle. Then you find candle 3 and look at the very bottom of its wick. Now here's the magic trick. If the top of candle 1 and the bottom of candle 3 don't touch, that empty space in between them, that is your fair value gap.
All right, so you found the gap. Big deal, right? Why does it actually matter? What happens next? Well, this is where the real magic comes in. It's something we call the market's magnet effect.
Let's go back to our painter for a second. A balanced market is like that perfectly painted wall. Every single price has been traded back and forth efficiently. But an imbalanced market, caused by that sudden fast move, is like a wall with a big old missed empty spot. You see, the market is kind of a perfectionist. It really doesn't like leaving these messy, inefficient gaps just sitting there. I mean, think about it. All the big trading algorithms, they're programmed to look for liquidity. And these gaps are basically just price vacuums. So the market has this natural urge to go back and fix it, to make things right. And this is the absolute core of it all. That gap, that empty space, acts like a powerful magnet on the price. Even if the price keeps running far, far away, that magnetic pull will often, eventually, draw it right back to that level to repaint the missed spot and fill that void. Okay, theory is great, but let's get practical. How does this build into a strategy that you can actually use? Knowing this pattern exists is one thing, but using it to catch a trade, that's what really matters. Seriously, understanding this concept isn't just some boring theory, it's your secret weapon. It helps you avoid the single biggest, and I mean the absolute most common mistake that new traders make. And that mistake is chasing the price. You know the feeling. You see that giant splash, that huge candle just shooting for the moon, and your brain, your FOMO, is screaming at you, get in now before you miss out. This strategy is all about fighting that urge. It teaches you to do the exact opposite. Be patient and wait. So here's the game plan. Step 1, you identify that fair value gap, and you just draw a box around it on your chart. Step 2, you do absolutely nothing. You wait. You patiently let the market's magnet do its thing. And then, step 3, when the price finally comes back into that box to fill the gap, that's your potential entry point. So let's just recap the whole process one more time. It's really just 3 simple ideas. First, you spot the big splash. That's the displacement.
Second, you find the gap it leaves behind. That's your fair value gap. And third, you wait for the price to come back to that zone. That's the entire framework, right there. And there you have it. You now have a tool to see the missed spots on any chart. It really makes you wonder though, doesn't it? Now that you can see these gaps, what else are you missing?